Good afternoon, and I hope everyone has been finding today's sessions to be insightful on the opportunities and challenges in mining as well as energy. Personally, after sitting through the earlier panel on energy, I think it's also a pretty good seg into the next topic, copper, which many people have actually hailed to be the new oil in the energy transition. So a bit of introduction about myself. My name is Jesline Tang, and together with my colleague Leah Chen, who was in the energy transformation panel earlier this morning, I'm also an editor with Platts Non-Ferrous team. And for myself, I focus on energy transition metals, which includes copper. Now, copper is often widely referred to as Dr. Copper, and it's traditionally been a leading indicator of economic health due to its widespread applications in critical sectors such as property, infrastructure, power generation, as well as transmission. And as we move towards a net zero world, copper will be playing an even more critical role in sectors such as the electrification of transport as well as renewables, which is why many people are now calling it a new oil. Today, I will be covering the spot market trends for copper concentrate as well as refined copper. And finally, we'll end off with a bit of an explanation about the role of copper in the energy transition, as well as some of the key challenges that need to be addressed in this industry. And just in case you're not sure who we are, some of you may be familiar with the Platts name, especially if you were at APEC or GasTech recently. So you may know that Platts benchmarks actually underpin many important contracts in the energy space, for example, JKM as well as Brent. But we also have a fast expanding suite of assessments in the energy transition metal space. So this includes, of course, battery metals like lithium and cobalt, as well as copper. And while pricing remains a focus for Platts, following our merger with IHS Markit last year, we are now collectively known as S&P Global Commodity Insights. And under CI, we actually have several prominent brands, including Platts and CERAWeek. This integration actually makes us more well-positioned to provide comprehensive pricing and analytics data to our clients. In fact, in the upcoming slides, you'll also see some supply, demand, as well as some other forecast data that is actually put together by our internal analytics divisions. So before we dive into what's been happening in the spot markets, I thought it'd be good to also give an overview of the supply chain to give some context about how pricing in the copper market actually works. Now, when we talk about copper, there's always a lot of focus on the LME copper price or, in regional markets, for example, the COMEX price or the SHFE copper price. And while exchange prices are definitely an indicator of demand as well as economics for any project, there are actually many other pricing aspects that inform the economics of a project in the copper supply chain. On this slide, you'll see a supply chain from mining to market. So on the left-hand side is actually primary production, so coming from mine to refined. And on the right-hand side, we have the process flow for secondary market. So this is coming from recycling. There's also been a lot more focus on recycling recently, but our own internal analysis shows that even in the most optimistic scenario, if we can keep recycling rates to be very high, most of the world's refined production will still be coming from primary production, so from mined copper. So what this means, of course, is that mined copper product prices are still very critical to the industry. So in the primary production process, after copper ores are mined, they're actually processed into what we call copper concentrates. So they have a slightly higher content, around 20%, 20 to 38%. And this is the main product that is sold to copper smelters, who further process this to form refined copper, or what we commonly call copper cathodes. And copper cathodes of a certain purity can be registered on the LME for delivery. So when people talk about stock levels on the LME, what they're referring to is actually the amount of grade A copper cathodes in the LME warehouses. So generally speaking, all copper products are actually tied to the LME or other exchange prices in some way. But there are also premiums and discounts applied to this product depending on their copper content. So if you look at copper concentrate as an example, there's actually the concept of a treatment and refining charge. We'll abbreviate that as TCRCs. This is actually a fee that is paid by the seller to the buyer to treat and refine copper. So in a sense, this is actually also a source of income for copper smelters. Sulfuric acid, of course, is also a byproduct of copper smelting that provides profit to them. And finally, copper cathodes, which are the main product of copper smelting, they are usually priced as a premium on top of the exchange copper price. So for example, in the international market, it would be a premium on top of the LME copper price. In regional markets, let's say in China, the domestic cathode market will be priced as a premium in Chinese yuan over the SHFE copper price. So in different markets, we can see that there is an arbitrage that emerges, and this informs people about the profitability of importing or exporting cathodes between different markets. And for today's presentation, we will be focusing on copper concentrates and cathodes in the Chinese market, as it remains the largest and also the most liquid spot market for copper today. Apart from the property sector, we see that the rapid rise of EVs as well as renewables in China has helped to spur copper demand, which is why Chinese demand still holds a very strong influence on the pricing of copper products in the near term. And just before I get into the spot pricing trends, I just wanted to highlight that Platts was one of the first to actually launch a daily TCRC assessments. If you're interested, you can look for us after this presentation, or you can also email us at our group email. So talking about the copper concentrate market, what we would say is that actually 2022 to 2024 is a very interesting period for this market. And the reason for this is that it's largely considered to be the last few surplus years for the copper market before we move into a very long and extended deficit that can last until 2050. Now, the near-term surplus up to 2024 is actually driven by the startup of several major mines. You may have seen this in the news as well, such as Kamoa-Kakula in the DRC, as well as Quebrada Blanca Phase 2, which started up in Chile recently. This has also encouraged smelters to push for a higher benchmark in their yearly negotiations. And we've seen a 5-year high of $88 per metric ton for the yearly benchmark this year. But as this section title indicates, the road ahead is actually pretty unclear because we see very few projects in the pipeline amid very rapid growth in smelting capacity. So this has brought a lot of scrutiny to current spot TCRC movements, especially ahead of the benchmark negotiations, which typically kick off during LME week. Now, the graph on this slide actually shows the Platts assessment for spot TCRCs between trader to smelter for standard clean concentrates. So in the copper concentrate market, there's actually many different brands. Some are cleaner than others. What we deem or call dirtier concentrates means that they have higher level of impurities, and in some cases, they may not be directly imported into certain regions. So due to time constraints, we can't really share the full specifications today. But just to give some context, in the case of the Chinese market, standard clean concentrates usually mean that they meet the requirements for imports directly into the Chinese market. And in terms of the counterparties, we do see that trader to smelter deals make up most of the spot transactions in the market. Of course, there are also some minor to trader deals, and these actually typically trade at a lower TCRC because traders actually have advantages, for example, being able to choose the quotational periods. We haven't shown the assessment here, but we actually do publish a differential for that as well. Now, if we look at the spot price trend so far, you can see that we actually recorded a dip in Q1 before prices rallied throughout Q2 to Q3 to the current level of about $93 per metric ton. In Q1, there were actually several major supply disruptions that contributed to this drop. So you may recall in December 2022 that there was some unrest in Peru following the ousting of the former president Pedro Castillo. So nationwide protests actually disrupted several mines, including Las Bambas, one of the major mines in the world. Las Bambas itself is actually responsible for 2% of global copper supply. Following that, we also saw a fire at Chile's Ventanas port, so that disrupted logistical operations for big miners such as Codelco as well as Anglo American. Third, we also saw a dispute between First Quantum and the Panama government, so this impacted logistical deliveries for Cobre Panama. And finally, just nearby to Singapore, we also saw heavy rain as well as permit renewal issues impacting shipping schedules for Indonesian concentrates. Now, despite all of these issues, the dip in prices was actually not as sharp as what people expected it to be. And the reason for this is because a lot of smelters had signed more term contracts in 2023 to take advantage of the higher benchmark. You can see that the benchmark has been denoted by the orange line here. And actually, the brunt of the disruptions was borne by traders who are also being hit by higher financing costs this year due to rising interest rates. So under financing pressure, we see that some traders have already reduced long positions in the spot market. And coupled with scheduled smelters maintenance in Q2, spot TCRC started to rise to current levels. We also observed an increasing number of tenders, especially for complex concentrates. So part of this reason, of course, was that due to a surplus market, smelters became a lot more picky about the types of concentrates that they wanted to buy. And as we see spot TCRCs going above that contract level, more sellers also try to maximize delivery in term contracts. So this further reduced the spot activity as well. Currently for Q4, I would say the outlook is kind of mixed. So on the demand side of things, there is expectations of new smelting capacity in China. So several projects that you may see in the news, for example, ZTS, Baiying, as well as Nangbo. But all three of these projects also run the risk of being delayed into 2024. And on top of that, smelters are historically not as active ahead of benchmark negotiations because they want to keep spot TCRC supported. But while we see, the current spot market to be very much a buyer's market, next year actually some people expect that the market balance will be tighter. And there's actually two main reasons for this. First of all, there is the expected Indonesian copper concentrate export ban, which will kick in mid-2024. Following that, there's also an expected startup at India's Adani copper smelter. It's a very big smelter, about 500,000 tons, which could kind of narrow that surplus a little bit. So therefore, we do see kind of mixed feedback about what the 2024 benchmark will look like. On the smelter side, obviously, 2024 expected to be kind of the last best year that they would get. Most of them are actually looking at higher numbers above the $90 mark. But on the sell side, because they expect the market balance to be tighter, some are actually looking at a rollover of this year's benchmark or just a very, very slight increase. And if you look at, Chinese customs data, actually some people may wonder, imports of copper concentrate to China are still increasing. In fact, they increased about 9% year on year on the same period. But in terms of spot TCRCs, it's not really reflecting that. So the reason obviously is because of higher term contract coverage, and spot trade data that Platts is tracking also kind of proves that. So according to our data, spot transactions actually fell about 35% from the same period in 2022. And many market sources we've spoken to actually describe this year to be exceptionally quiet. And even in July to August, so Q3 typically kind of a peak season for the industry, we are not really seeing a pickup in spot transactions as well. So obviously this is also pushing the case for smelters to push for a higher benchmark in 2024. And just in case you're wondering where we get this data from, we actually have a very wide source database of about over 50 sources. Half of them are smelters and the rest are miners and traders. And we collect this information on a daily basis. Now, at the start of this section, we actually said that, until 2024 is kind of the last few good years for the market. From 2025 onwards, our internal forecast shows that the market will flip into a deficit, and this is largely driven by strong refining capacity growth in Asia, as you can see on the graph on the right. In China alone, smelting projects will add 2 million tons of capacity by the end of 2025. Meanwhile, Indonesia and India will also add about 1 million tons to the mix. But on the supply side, things are actually not that optimistic. I think starting from 2022, we've seen a lot of news about how Chile's copper production has been going down, in part due to water shortages, but also due to the old age of the mines. And if we look at the pace of mine discoveries, they've also declined significantly, and it's lagging far behind the buildup of refining capacity. So according to data by S&P Global, most of the copper increases in recent years have actually been due to older discoveries. To kind of give you some context, between 2013 to 2017, copper discoveries totaled 70.6 million tons. That is 17 times the volume that was discovered between 2018 to 2022. And this is despite increasing exploration budgets, although some people will argue that a lot of these budgets actually have not been dedicated to grassroots exploration. A lot of it has actually gone into exploring and extending known assets. But this strategy will not be able to bring, significant supply into the market. So obviously this is something of great concern as well. And now moving into the refined market, the global copper cathode market has actually been quite hard hit by macroeconomic headwinds this year. The irony actually was that towards the end of 2022, because of the Russia-Ukraine crisis, and Russia being quite a significant supplier of copper as well, we did see that term contract offers increased a lot. So for example, major producer Codelco actually offered $140 per metric ton to its Chinese customers and over $200 per metric ton to its European customers. And what this means was that because the spot market has been pretty dead this year, many people who signed term contracts actually missed out on cheaper deals in the spot market. China is still the leading importer of copper cathodes, but demand has been quite bad for most of the year because of the slump in the property sector. We also observed that copper imports are increasingly challenged on rising financial costs. So this risk could actually cause the spot market to shrink even further into 2024 as some traders reduce their positions or exit the physical market altogether. In fact, in 2022, we saw that China's former top copper importer, Mica Group, they faced a liquidity crunch which impacted its ability to pay suppliers. And before this crisis, actually, Mica handled about a quarter of China's refined imports. It was also a very important intermediary between Chinese consumers and global merchants such as Glencore and Trafigura. Some market participants have reflected that the absence of Mica Group might have impacted refined copper imports this year. We see that total imports from January to August have been down about 10% year on year. However, we also see a rise in copper concentrate imports. So this could actually illustrate, an increase in self-sufficiency in the Chinese market, posing a further threat to the import cathode market. Now, all of these factors have made for an extremely challenging year for copper cathode traders because the import arbitrage cycle has been very infrequent and short. You can see on this graph here the Platts assessment for cathode import premiums. This is for LME registered normal brands. And you can see that, import premiums have been under pressure for most of 2023. Now, the line at the top indicates the benchmark offer for 2023, which is $140. Based on our assessment, the average spot premium so far is not even $45 per metric ton. So that's not even half of what was offered for the term contracts. And what we saw last year as well was that because the cathode term contract offers were so high, some people actually signed less term contracts. And they initially expected that, in 2023, we might see a more active spot market to make up for the lack of term contracts. Of course, that hasn't clearly taken place. We see that the sluggish property sector in China is still dragging on cathode demand throughout the first half of the year. So far, there has been some stimulus to kind of boost property sales, for example, reducing interest rates. But market participants are still very concerned about its effectiveness in the market. And I would say generally that market sentiments are still pretty bearish on import cathode demand. Now, it's not to say that everything is doom and gloom. We do see some bright spots in renewables demand. So coming from areas, for example, EVs, solar power generation, as well as the power grid. In Q4, there's usually also seasonal demand coming from the power grid. But some people are concerned that it's not enough to digest growing supplies, not just in the domestic front, but also in terms of import supply. So in the domestic market, as we mentioned earlier in the copper concentrate section, there is growing refining capacity. And in terms of import supplies, we're also seeing large inflows coming in from Africa. This brings us actually to another factor that might impact import cathode interest, which is the supply of cheap non-registered cathodes. So certain African projects, for example, Tenke Fungurume, they produce what we call equivalent grade or EQ cathodes. These are cathodes that are very chemically similar to registered brands. The only difference is that because they are not registered, they are usually traded at a lower premium compared to registered brands. But in terms of, end-use applications, advances in technology actually allow many consumers to switch to these cheaper non-registered supply. So it is definitely more attractive for them to go for this, which may further reduce interest in registered supplies. Of course, what could also happen is that we could see changes in trade flows. So instead of registered brands going to China, they may go to regions that actually have higher ESG requirements. So for example, Europe. Now, with this in mind, it will be quite interesting to see how the 2024 benchmark negotiations play out. And ahead of the upcoming LME week, so that's when negotiations typically take place, we do expect that the market will remain pretty subdued because sellers obviously are incentivized to keep premiums high. And at the same time, buyers are still, sitting on a fairly comfortable position, we would say. Looking further ahead, I think macroeconomic headwinds will continue to challenge cathode consumption. We've seen this particularly in Europe and the US, where manufacturing PMIs have been in contractionary territory since Q4 last year. And in the Chinese market, the uncertain outlook of the property sector is still a huge problem. Of course, towards the year end, there's some expectation that there may be further support measures to drive growth. But if we look at kind of the stock exchange levels, it is still reflecting widespread global weakness. Now, we see that in mid-July, warehouse stocks across the major exchanges, LME, COMEX, and SHFE, had been at historical lows, but across Q3, they've been increasing quite rapidly. So taking LME for an example, we do see inventory sitting at about 140,000 tons, which is more than double of the lowest point recorded in July. Comparatively, in China, SHFE stocks have not increased as fast, but they are still tracking a consecutive increase over the past month. And we do expect to see, this trend persisting into Q4, which might increase downward pressure on copper prices. Now, in terms of the supply-demand balance, our internal divisions indicate a growing surplus in the refined market up to 2025. And then that surplus will start to narrow from 2026 onwards, largely driven by demand from the energy transition sectors. And this will cause the market to go back into a deficit in 2027. Now, beyond 2027 is where I think the market starts to get very worried because the deficit could snowball if supply does not catch up. This is because we expect copper demand to increase by more than 82% between 2021 to 2025 in order to meet the net zero goals by 2050. And now we come to the final section for today, which is what's next for copper. As we've experienced this year, growth in traditional sectors such as property is slowing down. Of course, this is in part due to weaker macroeconomic conditions as well, but it is undeniable that the global focus is now shifting towards energy transition sectors. So how will the energy transition affect copper demand, and will a deficit actually short-circuit our path to net zero? This question is actually dissected and analyzed in a very well-known report published by S&P Global. It's called The Future of Copper. Today, I will be sharing some of the important insights from the report. And if you're interested to get the full copy, we have the link in the deck here. So one of the key conclusions in the study actually is that energy transition sectors, particularly from power infrastructure and EVs, they will become key demand drivers, making up about 30% of total demand by 2050. This is compared to just under 10% in 2025. So to kind of give some context, for example, in the EV space, BEVs actually consume a lot more copper, about 2.5 times more than regular ICE vehicles. And of course, we see many governments rolling out policies, incentives, or even mandates requiring EV adoption. So this is definitely something that will accelerate copper demand. And within the same time frame, traditional sectors and also expanding areas like communications and storage, they will continue to grow. So we are looking at a more than doubling of copper demand by 2050, just over 50 million metric tons in order to meet our transition goals. Of course, this huge surge in demand is raising questions about whether the world can actually ramp up supply on time. In this report, our analysts actually look at supply from two different scenarios. The first is a high ambition scenario. So we assume that mine capacity utilization increases to very high rates by 2035 and that recycling rates continue to increase. In this scenario, high copper prices will actually incentivize smooth operations and minimize disruptions. However, even in this scenario, we will still look at a small shortfall of about 2 million metric tons in the 2030s and then a surplus from 2040s onwards. In the second scenario, which is the Rocky Road scenario, it reflects the average trend over the past decade. So what this means is that mine capacity rates will be held constant at about 84% to 2050, and recycling rates will also remain constant. In this scenario, there are multiple challenges that are actually already happening today, impeding supply growth. And ultimately, what this could mean is that we could look at a chronic shortfall of 10 million metric tons by 2030, which would be untenable to the market. Now, realistically speaking, we might not actually see such a big deficit because supply and demand side reactions, they will respond to supply gaps as they emerge in the market. And of course, we can further improve the market balance by addressing some of the key challenges in this industry. So this slide actually shows the 8 key challenges that were highlighted in the report. As you mentioned earlier, some of them are already happening today. So a classic example is actually local stakeholders. Some of you may know that social license in Latin America, which is where most of the world's copper is mined, it has become increasingly difficult to obtain and will likely cause longer delays to when a mine can start up or decrease mine utilization rates significantly. One example, of course, is Peru's Las Bambas mine, which has been troubled by frequent and sometimes violent protests since it began operations in 2016. As a result, operations at the Las Bambas mine have actually been interrupted for more than 400 days since it started in 2016. On top of that, we also see that politicization of contracts and industrial strategy, they may also increase miners' commitments before they can obtain approval for projects, slowing copper discoveries. With growing focus on critical minerals such as copper, there are risks that mining policies may change dramatically in regions that don't have stable frameworks or predictable policy. So this might discourage much needed investments to develop these resources. And another significant challenge is actually stricter environmental standards. In the previous panel, we talked about sustainability. It is very likely that regulations mandating sustainable practices will become an international norm. In Chile, for example, we see that water scarcity has actually caused the government to pass legislation to control the use of fresh water in mining. Mining companies are turning to desalination, but these facilities do take time to ramp up. And even today, we see that production at Chilean mines is still very much plagued by water shortages. Following that, the lowering of greenhouse gas emissions is also a challenge for the industry. Of course, some of these challenges are more complex than others, and to address all of them would actually require very close partnership between governments, producers, as well as end users. Drawing on the conclusions of the report, our analysts have actually identified 3 priority areas for further exploration. First of all is actually technology to enable clean and efficient extraction of copper. This will help to address stricter environmental regulations, the ability to secure permits, and also increase proper production. Second, clear, stable, and predictable policies. This will help to reduce the risk of local stakeholders or political issues delaying mine production. It will also help to give the industry kind of a clearer timeline and the investment requirements needed to develop a project. And finally, understanding interdependencies between critical minerals. What this means is that in order to reach energy transition goals, obviously copper is not the only critical mineral. There are many other ones such as battery metals. And understanding issues that are happening for the other key minerals as well is important to ensure that these issues do not repeat in the copper industry, which might stifle progress. And with that, I come to the end of my presentation. I hope this session has been useful to understand the copper market and to kind of, I think, shed some light about some of the challenges that are faced by this industry as we move towards a greener world. Thank you. I think we have about 2 minutes for questions.
Hi, afternoon. Just one quick question, please. On the slide just now earlier, you had a chart on the copper demand from energy transition minerals, the 35, 40, yeah, this one. I'm just curious, why is the contribution from autos and charging falling that drastically from 2035 to 2040, so like almost halving the bright blue bar?
Okay, I think you do, there's a different way to look at it. Instead of a halving, what we would say in this report is that it is a demand will peak in 2035 because, for example, in certain jurisdictions such as EU, there is a mandate that all gas-powered vehicle sales must stop by 2035. So ahead of some of these goals, we will probably see an increase in the installations of EV charging infrastructure in order to, allow for that switch to happen. Yeah.
Okay,
Yeah, but for more detailed information, you can download the report. So they have kind of what are the different demand scenarios. Actually, what is shown here is in, the most optimistic case, if we are to meet, all of the net zero goals by 2050. There are other scenarios where, we don't meet it, but it doesn't mean that we will not face a deficit in the future. demand from energy transition will still continue to grow, but probably just at a slightly slower pace.
For demand comes from the construction sector, and whether that will change in the coming years. Have we seen peak copper demand from the construction sector in China? And any idea how much that would account for in terms of total Chinese copper demand by any chance?
I think some people have put demand from the construction industry, and I mean this not just in terms of property, but in terms of the associated things. So, for example, appliances, other installations that are related to property sector, to be at most about 50%. Some people do expect that it will kind of go down. It's not to say that growth will completely stop, but as we can see in the Chinese market, they are moving towards, for example, increasing EV charging infrastructure or also building more renewable capacity. All this will definitely be, I would say, the fastest growth drivers in that market. Towards a longer time frame, I think it's a bit difficult to say kind of what that proportion will be. Yeah, but I think in recent years, some people say that on top of the, I think, crisis that is facing the property sector now, they do feel that the government may be shifting towards kind of more of an energy transition kind of narrative. So that might kind of, I think, slow down the growth in the property sector.
Thanks, Jesline. Just one very quick one as well. So we've been discussing today that project lead times in terms of resource development for copper is at least 10 years. Very primitive question. How long does it take for a smelter to be up and operational?
In China, about a year.
Okay, understand. Thanks.
Yeah.
Thank you, Jesline.